Okay, welcome everybody to our Correspondent Banking Academy today. My name is David Howes. I'm the Head of Financial Crime Compliance at Standard Chartered Bank. I'm based here in London. I'm really pleased to see we've got a great attendance today for our first event of the year. It's reassuring to know that the level of interest among our partners and among our clients in tackling financial crime and in taking on some of the risks that we face this year is as great among you as it is for us here at Standard Chartered. So correspondent banking, it's been at the cornerstone of transaction banking for many years, facilitating cross-border flows of goods and services, connecting banks, connecting their customers around the world. It's core to the purpose of the Standard Chartered Group of driving commerce and prosperity. But it also comes with some challenges and exposes banks to inherently higher levels of financial crime risk. It's a space also where we've got more limited information regarding originators, regarding beneficiaries, regarding the nature and purpose of transactions. And as a result, we've got less opportunity to manage those risks in the way that we do for direct clients. That's not something that changed in 2020. But 2020 was a year when many other things did change. In unprecedented challenges we faced around the world, I think, from the ongoing pandemic impact on businesses, but also on the personal circumstances of many of us. I think we're also seeing change in regulation, change in politics, and with all of that, change and evolution in the nature of the financial crime threat. In response to all of that, in many of our societies, we are absorbing some quite astonishing adaptation to those challenges and those changes. I was talking to a partner at one of the big consulting firms yesterday who quoted Vladimir Lenin to me. It's not a particularly common combination I'd expect to find of McKinsey and Lenin. But the quote he shared with me was, "There are decades when nothing happens, and there are weeks where decades happen." And I think that's been part of the experience of 2020. If you look, for example, at the way in which the digital penetration of payments has accelerated, I saw a statistic whereby US digital payments put on more percentage points of growth as a share of total payments in just 4 months of last year than they had done in the preceding 10 years. And some of those changes are changes that will not reverse as we as a global society get to grips fully with the pandemic. So I think we're entering 2021 in a very interesting world. And today we're going to pick up some of the key themes and challenges faced by countries and in different parts of the world as we think about the risks that they generate for us in relation to financial crime. To do that, I'm joined by 3 colleagues and friends of mine here at Standard Chartered Bank. You're going to be hearing today from Paddy O'Hara. He's our Head of Financial Crime Compliance for Asia, based in Hong Kong, having joined us in 2013. Prior to that, he'd been at JP Morgan for 15 years in Singapore, London, and Hong Kong, and has worked across fraud investigations, AML, sanctions, and anti-bribery. Vince Heinz also joins us. He's our Regional Head of Financial Crime Compliance for Europe and Americas. Prior to that role, Vince had developed our controls team in the Americas. He was responsible for intelligence, surveillance, investigations, and a lot of the remedial work that Standard Chartered's New York branch had to take in response to our various historic settlements. Vince, I think, must be an insomniac because he's joining us from New York and it's about 3 o'clock in the morning. And then thirdly, Bevan Pillay, who's our Head of Financial Crime Compliance for Africa and the Middle East. He's been working with Standard Chartered since 2014, first covering Africa, then adding the Middle East to his portfolio from 2016 onwards. And Bevan's joining us today from Dubai. Before we get into it, A couple of housekeeping points that I ought to highlight. Not all of you will be familiar with the Blue Jeans event platform we're using today. Indeed, we'll find out how familiar I am with it as we go through the event. But please note that your camera and microphone are going to be muted throughout the session to avoid disruption. If you'd like to ask questions, and I'd really encourage people to do so, there is a panel. It should be on the right-hand side of your screen labeled Q&A. You can type your question into that box. We'll try and pick a few up as we go. But also those that we don't get to, we'll seek to answer offline after the event. We're going to try a couple of polls as we go through the session. They'll pop up on the screen, and when that does so, you can cast your vote by clicking on the relevant speech bubble icon. And then finally, at the end of the webinar, you simply click the red button at the top to disconnect. There'll be a prompt for your feedback. We would always welcome that. So to get us started, I think what I might do is run the first poll that we have. Maybe I can pull that up. I can see it's gone live on the box there. And that poll asks the question, my main risk in 2021 are related to A, cybercrime and fraud, B, sanctions, C, fintech and emerging technologies, or D, high net worth clients. Whilst you're voting on that, I'm going to move to my first question, and then we'll circle back round to look at the results as we go through it. But to get us started, Vince, I'm going to turn to you first. My question, the US dollar remains the world's currency of choice for international trade. We expect that to continue to be the case for the foreseeable future. It also means that those who want to access the US dollar and the US financial system need to comply with the respective requirements. What does the group here need to know about upcoming changes in the US regulatory environment? Perhaps you could talk to that for us, Vince.
Absolutely. Thank you very much, David. It's a tremendous question. And actually, at the very end of 2020, there was a flurry of statutory and regulatory activity in the United States that directly speaks to your question. For example, the Financial Crimes Enforcement Network of the United States Treasury announced rulemaking that essentially will create a requirement for certain institutions and actors in the market to file the equivalent of cash transaction reports for crypto assets. Does not affect wholesale banking directly and immediately. However, those of us who've been in the space a while know that every time a filing requirement is created by law, rule, or regulation, there may be an incentive to bypass those requirements, and we may see that manifested in typologies similar to structuring on the cash side of crypto-related transactions. So that's on the horizon. More broadly, the Congress on January 1st passed a package of legislation treating a variety of different public policy matters, one of which was the AML Act of 2020. That act, David, goes in two different directions. The first direction I guess you might characterize as progressive. What we see in the AML Reform Act of 2020 is a mandate to the federal regulators in the United States and law enforcement to combine and generate a holistic, unified strategy around financial crime risk management and the regulation of controls around that, which will express itself over time in the form of standards that will be published. This is welcomed. This will give all of us, both in the United States and our respondent clients around the world, better transparency in terms of exactly what regulators are expecting, exactly what they will test. So that's very much welcomed. There are also welcomed developments in terms of public-private partnerships being encouraged and innovation in terms of technology being encouraged by that same legislation. Some of the complexity of the legislation is in the form of a long arm type provision that essentially would create liability for a U.S. correspondent bank in terms of acting as an agent for overseas clients for the purpose of service of legal process from the Department of Justice. That is a new rule, a new expectation, a new standard. It's being analyzed by the legal community and others right now, but it certainly will be a complicating factor as we move forward in terms of the cross-border banking world. So those are just some of the recent events, David, and they all came in the last couple of weeks of 2020 and the very first day of 2021.
Which sort of goes to that point that a lot of acceleration there and some changes that the industry's been talking about, indeed advocating for in some cases for many years, all getting done in a rush. And experience suggests that we will now spend a significant period of time adjusting and adapting to it, which I have no doubt will keep us all busy. I can see that the poll results have come in on that first question. Quite interesting. 50% of you picking cybercrime and fraud as the main risk to worry about in 2021. 26% fintech and emerging technologies, 19% sanctions, and just 5% on high net worth clients. And I find that quite fascinating that there is, in many ways, a strong correlation of views around that first topic. If we'd asked these questions just 10 years ago, I'm not sure cybercrime would particularly have been registering, and I think sanctions might have been a lot further forward. And it's reflective of the changing threat environment that we're responding to, that you see some of those shifts. I might, in moving on to our next question, ask Paddy also to reflect on that. So one area of significant business growth we're seeing in Asia is in the financial technology or the fintech space. And perhaps, Paddy, you could talk to us about fintech growth and how you see those emerging risks and how you see them changing the way in which a bank has to manage those risks in that space.
Thanks, David. And before I start, and I think just from that poll, I don't think there's many people from Hong Kong or China on the call, because I think sanctions would have been a lot higher if it was. I also just want to give a shout out for Vince, not just because it's 4:45 in the morning for him, but he can be that articulate at that time in the morning. So the fintechs, yes, there's been an explosion of fintech growth in Asia in the last 5 years, and it comes from all countries, but there are some standouts. And if I go from west to east, India, Malaysia, Singapore, China, Hong Kong, Korea, Japan probably stand out most. And these fintechs cover everything: supply chain, finance, card aggregation, payment platforms, and now crypto assets. And the FCC risks vary depending on markets and products, and I guess the clients themselves. And I've thought about this question, and I think the biggest risk, which sounds, I guess, a little bit trite, but is knowledge. And knowledge in three areas. So the first one is knowledge in the banking industry, where we're playing catch up and have been since the start with fintech. Because a bank doesn't know the risk until it has people who understand that risk. And I'm not just talking about second line of FCC, but this is the business and the audit functions as well. Because a fintech, especially a new one, can change its direction and products almost overnight. And we've seen it happen. And RMs need a deep understanding of the client and also of the risks involved in different types of products and services. And and also when to escalate these, because otherwise there's going to be problems. The first. The second is knowledge in the fintechs themselves, or cross-border payments, and need to partner with banks. They do understand the need for robust AML frameworks, but often lack the funding or people experienced in compliance, especially when they start out. And the third area of knowledge is with the regulators. Regulators have struggled as banks have, and have either had to learn or bring in people who understand the fintech world. Now, many regulators in Asia now are using sandboxes to allow fintechs to test products and services. And some, like the MAS in Singapore, have come out with forward-looking guidance, but not all regulators are working at the same pace. The knowledge is the big one, I think, but and everything else is really secondary. But there are 5 quick areas that come to mind. So the first is anonymity, or lack of knowledge of the clients, of the fintech clients, fintech itself. You could kind of liken that to correspondent banking. The second is the speed and complexity of the transactions today. How do we and the client monitor these? Do we need a new way of monitoring? Third is geography. If the clients or their transactions involve high-risk countries or countries with loose regulatory supervision, how do we get comfortable with that? Another is payment transparency. There's no regulatory or industry consistency on how payment should be populated when intermediaries are involved. So information can often be dropped along the way. And then finally, channels. There are so many of them now. For instance, we've seen larger fintechs and wallet providers essentially using a hawala system, having funds in bank accounts around the world and just debiting and crediting within them. Nothing wrong with that. It's just that banks need to know their clients, need to understand their products and the controls of the clients well enough to get comfortable with all this complexity in the brave new world. Back to you, David.
So, Paddy, thank you. I found that a fascinating answer. I, in addition to my day job, sit on the board of a fintech in which Standard Chartered has an investment, and it operates in the payment space. And as I was thinking, I was listening to your intervention. I was thinking about the point you're making there on knowledge, and underlying it is a bit of a culture clash between the way technology entrepreneurs go about doing business and the way that heavily regulated financial institutions go about doing business. There's a tension there, and it's an interesting one to manage, because I'm absolutely certain that the acceleration to digital and the digitization of cash and all that goes with it is not going to go away. But the build-up of the knowledge base on all 3 of those communities is essential if we're going to avoid negative, unintended consequences. And I think that's a real risk for the innovation that's going on in fintech, but it's also a real risk for the banks. So something I'd really encourage people here to be thinking about and looking for is, can you identify where you've got what is in effect a digital MSB operating within your network? Can you identify it, and can you engage with it? And putting my non-executive director hat on, I do think plenty of these fintechs out here want to get to the right place and want to do the right thing. Struggle actually to get access to the banking system, and some, I don't doubt, will start cutting corners in response to that and creating risk for the banks that they work with. And you can imagine a kind of equivalent to the correspondent banking de-risking process kicking off in this space in reaction to events, which would be a really unfortunate scenario to allow to develop. So thank you for that, Paddy. I'm going to move us on now to the next question, which I'd like to put to Bevan. And switching gears a bit here, Bevan, albeit on the same theme around de-risking. From your perspective, which areas of focus do you think people need to be looking at in Africa and the Middle East to prevent the de-risking of banks and to further the objective of correspondent banking access in emerging markets there?
Thanks, David. A decline in the number of correspondent banking relationships has been a source of concern for the international community for some time, especially in Africa and Middle East, considering the large remittances involved and cross-border trade. In affected jurisdictions, this decline may impact the ability to send and receive international payments or drive some payment flows underground, with potential adverse consequences on international trade, growth, financial inclusion, as well as the stability and integrity of the financial system. Over the last decade, global banks have been tightening operations to comply with regulations designed to curtail money laundering and terrorism financing. As a consequence, global banks have been limiting correspondent banking relationships with local banks in emerging and developing economies. Arguably, the most impacted region is AME, Africa and Middle East. Global correspondent banking relationships have fallen by around 25% since 2009. De-risking is a trend in the industry which involves banks and other financial institutions terminating relationships with entire sectors of clients that are deemed to be too high risk. The theory behind this is that by disassociating itself with an entire client type, a financial institution will lose business and income, but this loss will be offset by not having to deal with increased risk of compliance costs that is part of doing business with a high-risk client base. The challenge is to keep the economy safe and inclusive. So de-risking by exiting banking relationships was a major concern until quite recently, as highlighted in the FATF guidance on correspondent banking. And it remains at times a necessary action. However, we at Standard Chartered have seen that there is an alternative. And that alternative is de-risking through education, whereby Standard Chartered seeks to share industry best practices, thereby promoting local banks' understanding of effective risk management and practices and international compliance standards. Standard Chartered has run an effective program in this area for several years now. This program encompasses access to our training materials and correspondent banking academies, where we bring together local banks to share best practices, industry-wide trends, and provide an overview of an effective compliance program. By sharing best practices around anti-money laundering, customer due diligence, and suspicious transaction typologies, our aim has been to help raise industry standards. We believe that by maintaining the security of the financial system, it need not come at a cost of financial exclusion. We focus on two pertinent areas which are critical from a financial crime risk management standpoint and are very relevant to the AME region. These are payment transparency and downstreaming, also known as testing. The AME region is predominantly made up of developing countries. Economically, de-risking can have a significant impact on financial inclusion and affecting the global trade of the market, which is critical to the growth and development of many economies. The best way to avoid de-risking is for correspondent banks to maintain close relationships with its respondent banks, to meet on a regular basis and seek updates on respondent banks' compliance programs, systems and controls. Correspondent banks should also monitor levels of sanctions, non-compliant cases seen for its respondent banks and take the necessary action if non-compliance is at an acceptable level. So this may mean temporarily restricting certain payment flows or corridors for certain client types, while the respondent bank improves its control. The ultimate recourse is, of course, to exit the respondent bank if the risk remains too high, but that should be the very last resort. Thanks.
Thanks, Bevan. And it's a topic that's been important and on the agenda for some years now. I certainly recall some of the work of the CPMI under the Financial Stability Forum, triggering focus on this at Wolfsburg 5 or 6 years ago. And whilst I think we've made progress, I don't think it's the case that we've completely solved the problem. I'm going to pick up now one of the questions that I see coming in on the Q&A board. Also encourage people to log questions in there. I can see Vince has already managed to answer one, typing away as we talk. But there's a question in there from Arun about utilities and whether they're still attractive to banks like Standard Chartered, and are they likely to drive more information sharing between banks? I think that's an unambiguous yes in my view. There's really two types of utility model that I think are relevant here. I think there's models that can make more efficient some of our processes by sharing information across different players in the industry and try and drive down some of the kind of plague of false positives that we all deal with. There are also, I think, interestingly, opportunities for models that are more effective from the perspective of providing highly useful information to law enforcement. And both of them are important because I think ultimately, if we're going to solve the challenge of financial crime, it's going to be in partnership across the public and private sectors, or it's not going to get solved at all. And where we are today is certainly not optimized in terms of where resources across private and public sectors go. A good colleague of mine has described too much of our work as being about chasing the innocent around the system. And I think we believe quite strongly that information sharing partnerships and working across the industry, working with law enforcement is going to be a more effective and efficient way of tackling this type of problem. With that commentary, I'd like to get the next poll loaded, if I could, please. I see it's gone live on the system, and our question this time is on this theme. So, my bank actively seeks partnerships with A, multilateral groups, B, government or regulatory bodies, C, industry groups, or D, none of the above. And whilst you are casting your votes on that, I'm going to move on this theme of partnership and usefulness to law enforcement to Vince again. Vince builds on some of the objectives we all share for financial crime, but how do you know if an FCC program is providing a high degree of usefulness to law enforcement?
It's a really great question, David, because it goes to the very purpose of having a financial crime compliance program on the one hand, which is to support law enforcement, and at the same time, the very sensitive nature of an STR or a SAR, the inherently confidential nature of law enforcement activities, the way law enforcement uses a SAR will all impact how much transparency or visibility or feedback the filing institution will ever get or can ever get. I mentioned earlier this new law here in the United States. One of the requirements is for FinCEN actually to come back to the banks and tell us which of our SARs have been more impactful than others. But again, we'll see how that plays out and how much visibility we're able to get and whether we can operationalize that feedback. Until then, I think we as financial institutions are left to do what we always do in other areas. We have to develop our own key performance indicators and key risk indicators. In the context of law enforcement, for example, in our program, we track every single inquiry we receive in response to our SARs in which supporting documentation is requested. And then we look at those numbers month to month, tally them, and get a quantitative cut of how much impact our SARs demonstrably have, recognizing there'll be another layer that we will never see where there's impact. And then qualitatively, we are starting to look at those inquiries, those requests for documents, and going back upstream into the casework and ultimately up into the surveillance activity that triggered the casework to see which detection scenarios are the ones that ultimately are providing the best intelligence, if you like, to the law enforcement partner, as opposed to the ones that maybe aren't. I'm not suggesting that is at all going to be a panacea for the complexities of chasing the innocent, the false positives that we all contend with, but it does provide some insight in terms of what is more impactful as opposed to things that really are not generating valuable and intelligence to law enforcement. So that's my reaction to that. And at the same time, I think we have to recognize we'll never have full clarity on ultimate impacts based on the nature of the fact we're providing confidential intelligence.
So thanks for that, Vince. And interestingly, as you were talking, the votes were coming in on that question. Quite a strong majority around government or regulatory bodies being the place actively to seek partnership at 38%. Multilateral groups and industry groups some way behind, and not many who are not seeking to do anything. And a sort of reflection on that, I think, is that if you'd asked this question again maybe 10 years ago, there probably would have been quite a lot around working across the industry, but the idea of partnering up with government or law enforcement might have been a bit more muted. And indeed, in my sort of early days working in this space, I don't think it was the case that law enforcement automatically saw banks as part of the solution rather than part of the problem. So I think there's some progress there. Having said that, I guess to maybe if I can ask you a follow-up, one challenge that banks often face is to get into enforcement action, go through a remedial phase, work off orders, and then a few years later find themselves back at the starting point, and that doesn't help us in progressing the arguments for a more effective approach to financial crime. I'm just kind of curious, why do you think that happens, and what's your advice to avoid it?
David, we have seen that as a dynamic in various markets where institutions go through a period of surging resources and fortifying their financial crime compliance controls, and then when the regulatory pressure returns to something more normal as opposed to an enhanced focus, there can be the risk of stepping or slipping back. I think the reason for it, honestly, is just the imperatives of business strategy and targets, which create priorities for institutions that have to be balanced. And it's not to be, none of us should be surprised that an institution that goes through 3, 5, or even more years of remedial focus at the end of that journey looks at itself and says, okay, we're done now. Let's focus elsewhere. And I think a technique that institutions should consider when they're at that inflection point, just as if it's a consent order that's been satisfied or lifted, or a cease and desist order, or some other agreement or commitment that's been fulfilled, should really take the time to do a deliberate lessons learned at least 2 levels. The first is what went wrong in the first place in light of the remediation. There'll probably be a root cause analysis early in the remedial period, but with the benefit of the remedial period, revisit that root cause analysis, and the institution may want to ask itself what really went wrong, list those things as specifically as possible, and then articulate for itself what it will do going forward to mitigate the risk that those things will reoccur. One particular area that occurs to me that may come out of that kind of an exercise has to do with issue management. We'll always have issues. Every complex institution has risks. We'll have gaps over time. We're talking about change management in this conversation, be it fintech or COVID or new standards coming out. Those will always create friction points, and there will always be some level of risk or issue to deal with. The question becomes, will the institution retain the wisdom to self-identify risks, potential gaps, potential issues, and develop a scheme of corrective controls, and otherwise use the identification of a gap in a global institution in one market to inform surveillance around potential similar issues in its affiliates? I think that's the mandate, is to do the deliberate lessons learned and make sure that type of issue management is baked into your BAU processes as the institution moves forward.
Okay, thanks for that, Vince, and I think you're absolutely right. I'm going to move us on and return to Paddy with a slightly different topic. This is returning to some of the trends that played through 2020, and I think will be with us over the long term. So one of the key issues ahead are international relationships, and in particular between the China and US powers. What's your advice for helping banks navigate the challenges that some of those tensions in relationships can throw up?
So thanks, David. I think there is going to be some level of reset with President Biden, but there's still real concern in the US around human rights issues, and there's disagreement over Hong Kong, Taiwan, South China Sea, trade, and all of this had bipartisan support under President Trump. So I don't think it is going to go back to what it was we didn't know it at the time, but the good old days of 4 years ago. And then on top of that, we've got climate change, which President Biden is focusing on, and that will become another potential area of tension. And I think so. If we sort of look into 2021, I think that the trade war is most likely to find resolution. I think there'll be less use of BIS and executive order designations, but President Biden has already said he'll be more inclusive going forward, and that means working with the US's traditional allies rather than going it alone, which is what's happened over the last 4 years. And so this is just going to bring added complexity to the picture as if more governments start piling in as well. And just thinking about the focus on human rights issues, we could see civil litigation in the US against those seen to be financing companies operating in these areas. And also commissions could be set up. And all of this is just going to influence public perception. If we look on the side, there are now legal frameworks in place to enact similar sanctions and restrictions to those that come from the US. The Chinese government has so far refrained from adding any new names that would cause significant impact. And I'm assuming and hoping that it's a wait-and-see position at the moment. And in fact, Xi Jinping spoke at the World Economic Forum yesterday. And though he didn't mention the US or Trump by name, he did warn of a Cold War if sort of isolationist and protectionist policies continue. So we really aren't out of the woods yet. And just to point out, is I've spent quite a lot of my last 5 months, I suppose, since the 7th of August, just thinking about sanctions. There are two significant differences between China and the US. And one is that the RMB doesn't yet have the global dominance that the US dollar enjoys. But also, China's laws aren't extraterritorial in nature, so it's almost dealing with uneven ground there as well. So how do banks keep up, and how do we deal with it? And how do we address the allegations of genocide with the moral and reputational risk these bring? I think it's a very different world that we remember of just complying with regulatory sanctions and looking for red flags, because we as banks have never been suited to implement foreign policy, although society and government seem to look to banks these days as extensions of a country's foreign policy. We have to comply with all applicable laws, local as well as the home country, including the US dollar. And if the future brings conflict of law, then all banks are going to have to make decisions. The AML Act that Vince mentioned at the beginning is a potential example of this, where we will get into conflicts of laws. And we're hoping we won't get there and that sense will prevail, but it's something we're looking at, and all banks should be looking at that. So what advice do I have for banks? And I think it will be a familiar refrain. It's down to people again, in two ways. So one is having people in your bank that have the experience and expertise, not just in US law, but China law now as well, to help guide us through that. But as we get into these reputational issues as well, and the potential that we're going to have to make choices, we need to understand our stakeholders and what's important to them. And our stakeholders are our employees, our clients, and our regulators. And any strategy, any stance that the banks take need to have the support of these three groups, or the strategy will fail.
So thanks for that, Paddy. I think that's a pretty thoughtful run through the tackling of the challenge, and I might sort of stick with that theme of sort of navigating a complex political and international environment, and in turning next to Bevan. Bevan, you may have seen also amongst the questions there was a request for a bit more detail on some of the Middle East dynamics, so you may be able to pick that up a little in your response as well. But what I was going to ask you to talk to is managing the risks around Iran, so somewhere that's long been at the forefront of international security concerns, certainly a focus in the West and internationally for sanctions, and you're operating in a number of countries in close proximity, in the orbit of its economy. Can you explain the current risk management stance and how it's evolved in response to to global trends in regulation.
Thanks, David. So this complicated subject of Iranian sanctions has continued to dominate global geopolitical newsfeed around the world and has a direct impact on business interactions with our increasingly intertwined global financial system. Global bodies and other countries remain concerned with terrorist financing and potential nuclear proliferation risk emanating from Iran and the threat that this poses to our international financial system. This means monitoring areas of Iranian influence and geographies susceptible to Iran's physical as well as digital reach. Added to this is the complexity of frequently updated and often varied US and European regulatory positions. And today, as much as ever, multinational corporations and global financial institutions must raise their awareness around the direct and indirect relationships of parties with whom they are doing business. The sanctions risk with regard to Iran are a constant concern for sanction professionals. For the financial services sector, Iran sanctions has long been and remains a major priority in terms of management of third-party risk. Managing the expanding risk of US sanctions can be handled at three levels. Firstly, you have to stay on top of the regulatory changes so that you know what the new or updated sanctions mean and how they impact your compliance program, what changes you need to make, what control adjustments are required, as well as what communications you need to put out to your clients and business teams. Secondly, you need to understand your clients, their ownership structure, their lines of business, which countries they're dealing with, and how they're dealing with them, and also who they're dealing with, which is counterparty risk. Lastly, you have to continue to understand Iran's interconnectivity, both regionally as well as globally, and follow the patterns, geopolitics, and then related changes as being aware how to alleviate circumvention attempts. Standard Chartered is present in 9 markets across the Middle East. All of these countries, especially the GCC, which is the Gulf Cooperation Council countries, are geographically located within very close proximity of Iran. The Standard Chartered's global sanctions policy prohibits any dealing with sanctioned countries and territories, which includes Iran. That means that the group does not undertake any transaction involving Iran, any party in Iran or the government of Iran, its agencies or even instrumentalities, wherever located. However, the geographic proximity to Iran poses its own risk, as there have been historic cultural links between the Middle East countries. Our risk management principles and policies adopt controls which acknowledges this as a high risk and employs elevated controls to counter this risk. An example of this is our sanction screening controls require independent checks to be performed and confirmation to be obtained for shipments involving this geographic gap. Similarly, internal intelligence obtained through investigations and other sources are effectively used to counter the risk of direct and indirect dealings with Iran. On a policy standpoint, the group has developed internal standards which defines our risk appetite for clients having exposure to Iran by other institutions. Thresholds are applied to compute such risk, and we take a risk-based decision on such relationships. I think overall, banks, fintechs, anybody that's doing business in the space has to consider the frontline controls to identify and manage such risk through a robust policy framework. I think also effective and specific financial crime compliance controls must be developed to counter the risk using processes and technology that are appropriately elevated when dealing with such higher risk jurisdictions. David.
So Ben, thanks. I've got sort of one eye on the question board and one eye on the time. I might try picking up a few of the questions where I detected a theme. So across, I think there's questions from Jody, Dolly, and Permpong, where I think all of them kind of come together in a way. So I think one of the top areas flagged in that poll at the start was around cyber-related crime. I think that one of the consequences of COVID and the acceleration of digital adoption that we talked about at the outset has been a corresponding acceleration of online crime, cyber-enabled crime. And I think with that, you see the development of money laundering infrastructure that is similarly more digital. So we have long thought about cash mules. I think we've now got digital mules out there being acquired. Similarly, the kind of fusion of that need with the use of shell companies and online channels and cross-border transfers is something we see as an emergent money laundering threat on the back of cyber-enabled fraud and as I say, accelerated by COVID. I think the second thing I'd pick out, expectations in relation to banks on fraud are starting to shift with a growing expectation, certainly in some markets and certainly in the UK, that banks will do more to protect their clients from fraud. And I think that goes into the question around what types of control can one deploy in an environment where there is relatively limited indicia of fraud in a payment. I don't think there's a brilliant answer to that. Quite a lot of the focus goes to preventative controls at the channel level and also customer awareness, education, and other preventative controls in relation to the creation of new beneficiaries and so forth. Actual monitoring controls, I think, are extremely difficult, particularly in a cross-border environment where you can't kind of leverage the type of national infrastructure you might use on domestic payments. But having said all of that, I do think there's something around the application of analytics to try and identify greater risk. And one thing that we've certainly put energy into, that I think people can put energy into, is tracing through post-event. Is there a typology or a client type that is heightened risk, and you start building greater DDD, KYC, and monitoring controls against clients who might be on the receiving end or in that digital money mule space in relation to fraud. I've used a good chunk of the time we had left in trying to pick up a few of those questions. There's some more there we're not going to get to, as I probably ought to give the final word for today to our panelists. We're into the last minute now, so what I'd like to ask each of my colleagues in 30 seconds, what's your best piece of advice for managing financial crime in 2021? Vince, you've just come onto screen, so I'll start with you.
My best piece of advice for managing financial crime into 2021, I think, is to establish within your organization a horizon scanning capability. We can easily be consumed in the press of day-to-day activity and instant requirements and the examination next week and the audit next month, but there should really be a capability that looks at the threat level, the policy level, the regulatory level that's on the horizon 2 years, 4 years out, in order to set conditions for predictive work and getting the controls in place before the risk hits us. That's, in a nutshell, what comes to mind, David.
Great. Bevan, do you want to go next? I'm not hearing you, Bevan.
Yes, I'm sorry. So I think, David, I think from a horizon risk perspective, I think collaboration is one aspect that is key. This is, collaboration in the AML space when we look at our engagement with regulators and other public bodies, but also internally, as we work more from home, we need to collaborate more internally so that we can identify horizon risk, identify and link up all of the issues within the bank from a risk perspective, so that we can identify potential financial crime risk in more coordinated manner. So I think for me, it's that collaboration piece that's key as we work in this type of new environment, working from home.
Okay, so we've got scan, collaborate. Paddy, what's your?
Bevan took way more than 30 seconds, so I'll be really quick. I would say people should be prepared as the global recession happens for a huge increase in both first and third party fraud.
Okay. So there you have it, everybody. Insights from some of the top team here at Standard Chartered. It falls to me then to thank everyone for joining us today. We didn't get through all the questions, so we'll try and get back to people on those. I hope you've enjoyed it and I hope you found it useful. In closing, I'll share my advice for fighting financial crime in 2021. I quoted Lenin earlier. I think I'll finish with Churchill. Never, never, never give up.